Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And of course, joining me today, Michael Becker.
Hey, Paul.
Mike, thanks for being in the podcast. Michael's also with Old Capital. Today, we're in for a treat because we have two of our friends joining us in the podcast. These are two guys that I've known for a long period of time. We've done a lot of business with them in the past, and they're going to give us some little insight about what's going on in the brokerage sales business in the state of Texas. So joining us in the podcast, we have Will Jarnagin, and also Michael Ware. Guys, thanks for hanging out with us in the podcast. I appreciate that.
Thank you for having us. It's always good to see you guys.
Likewise.
All right, good deal. So we're going to talk a little bit about what the state of the market is, some of the things that these guys have some insight on, and I think it's just going to be a very dynamic conversation. But let's kind of talk about, now you guys are with Berkadia, and who the heck is Berkadia?
You want to take this one?
Sure. So Berkadia is a Berkshire Hathaway-owned company, and we really have three main lines of business. Investment sales, which is the part of the company that we operate in. We have mortgage banking and servicing. We're the third largest loan servicer in the world, and back in 2013, Berkadia acquired a multifamily investment sales firm called Hendricks & Partners, which then became the investment sales arm of Berkadia. Michael and I specialize in multifamily investment sales in Dallas-Fort Worth.
So how long have you been with Berkadia?
We moved over in July of last year.
But you guys have been in the multifamily business for a long period of time. And I'll ask this question. Will, where did you go to college?
Baylor University.
Baylor University. Michael?
Tulsa, North Texas, and I'm actually in SMU right now.
SMU?
Yeah, I'm back in school. Don't know if that's a good idea or a bad idea.
For your master's?
That's correct.
Always learning. I love it.
That's right.
So how long you guys, Mike, you've been in the market and DFW doing multifamily sales since what, about 2007 or 6?
I started in late 2005 as an intern, and then started full-time in January of 16.
And Will, what about you?
I started in January of 2005, so going on 12 years now.
So here we are, 2005, went through a cycle, now raged back out. What's kind of your general state of the market right here? I know you guys focus in North Texas, primarily in DFW, but it's kind of all the North Texas market. What are you seeing now, and how does that kind of differ from, pre-recession, during recession, and now that we're way past the recession?
Yeah, so I think it's still sizzling hot right now. Again, I'm a broker, so it's always hot. But from a job growth standpoint, population growth, capital flow, everything's leading in the right direction. I don't see a lot of major headwinds, and we talk about this all the time, obviously. But it's just all things are green right now in Dallas-Fort Worth. There's a lot of people that want to be here, that are out of state and even out of country. Hopefully things keep going that way. Time will tell, but I think for the foreseeable future, and just me personally, I think long-term, 20-year outlook, Texas in general is going to be one of the meccas of growth in the U.S. So we're really fortunate to be in Dallas-Fort Worth and in the multifamily business.
Yeah, and prior to this conversation we had, Michael and I were just talking about maybe some of his neighbors, and you were saying a couple of your neighbors are transplants from
Toyota, right? They're all coming from California, from Southern California to the northern suburbs of DFW. They're all flocking, buying seemingly inexpensive houses relative to what they're selling back at home.
Yeah. And that story, the Toyota story, is really the preeminent corporate relocation story in America right now. So it's certainly a boon to our market, but there are a lot of companies moving in. And, generally what we're seeing is that, rental rates are at all-time highs, occupancies are at all-time highs. And we, I think, in general, believe that as long as rates remain low, that the sun will keep shining here.
What I read too, which I thought was interesting, is that I'm not going to say that all the people that have moved from California to Texas are going to be apartment people. A percentage of them are, but most of them are going to probably be homeowners, because that's I'd say a white collar job of a person moving in. And since we're in the B and C apartment space, for every one person moving in, there's like 5 people that have to support that person, whether it's at a Starbucks or a Home Depot or cutting their grass or something like that. Those are our tenants. Those are the ones that have to support the B and C property. So for all these white-collar people coming in, we have the hardworking blue-collar people coming to support them too.
Yeah. So you guys were in the market in 2005 when it was kind of frothy and crazy. So obviously, to me, our pricing today has far surpassed what the peak was pre-recession. How does it feel different today? I mean, we talked about jobs, so maybe that's the answer. But is there any sort of nuances of what you felt back then versus today?
Yeah. So a couple things off the top of my head. I feel that the lenders are actually more conservative this go around. It's harder to get a loan, I think, as a buyer, so you have to be a little bit more qualified. The lenders are scrutinizing the deal more so than they were back when I think we were first getting into the market. I mean, in 05, 06, if you could fog a mirror, you could get a loan, and it was leveraged to the hilt. Non-recourse. Most of these people didn't have any clue what they were doing. They were getting loans, and when the market turned, they got caught. I think this time around, people are a little more cautious, and I just think that overall, the underwriting's gotten a little tighter.
Yeah, just like there was subprime single family, in areas of Southern California, Texas, Ohio. There was also subprime multifamily, and that's what Michael's talking about, is that there was subprime people in the multifamily space. And so if you put down 10, 15, 20% and you had no experience doing multifamily in the past, you were still able to get a multifamily loan. So that's not the case anymore.
Yeah. Volumes. What are you guys seeing as far as like number of transactions over the last several years? How's 2016 stacking up compared to 14 to 15 for your guys, your shop?
Yeah, so this is something that we track pretty extensively, on deals typically over 100 units. We track every single transaction in the market. And 2015 was certainly a high watermark, compared to, we track all the way back to 2009, the low point in the market. And, 2016 is going to be on pace to do just about that. I don't think we'll see a significant increase in that, but we will see a significant increase in the dollar volume, mainly because pricing's going up. There's a few less entity level and portfolio deals that are happening this year, so that's kind of back off the number of transactions. But by and large, this is one of the highest transaction activity markets that we've seen in the last decade.
So to throw some history on this, in 2009, for all deals in Dallas-Fort Worth that were over 100 units, you're looking at roughly $1.5 billion in total sales volume. And last year, we were just under $8 billion in total sales volume.
This year will be a little ahead of that, you think?
I think in total volume we'll be a little ahead of that. And deal transactions, we were at 290 last year, and I think we'll say be pretty that. Either a little below or right on it, but prices are going up, so
So that means cap rates are have compressed over the last, say, 12 months?
Definitely so.
So a little bit of perspective. So what was, it's kind of generalizing, across asset class. What have you guys kind of seen between the A, B, and C as far as cap rate compression over, say, the last 12 months or so?
Sure. The first thing that comes to mind is the typical broker answer. It depends.
Sure. Every deal and every location is a little different. But
buyer cap, seller cap, lender cap.
Generally speaking.
Then there's the broker cap.
Yeah, I'd say that, in the B class realm, we've seen maybe, 50 basis points or more cap rate spread tightening. And in the C class, I think you probably have a little bit more than that. I hate to say that it's a full 100 basis points, but, and certainly on some deals it is. And rates have also, I think, come down some in that time. So that's, partly fueled it. But, certainly the competition in the marketplace is fueling it as well. So
how are you seeing deals that you have on the market now versus, say, about 12 months ago, as far as like the number of offers that you get per deal and the quality, and do we have one or two that are standing out from the pack, or is that changed at all?
I think that, so on our regular deal, we do anywhere from 25 to probably 35 tours. We'll get 15 to 20 qualified offers, and then we usually take the top 5, unless there's a pack that forms, which is pretty typical. We'll take those people into a best and final round, and then ask them to differentiate themselves or really kind of sharpen their pencil and figure out what they can do. Talk to their lender. Really get qualified, and then it usually does come down to two or three buyers that have lost, several deals, or they, for whatever reason, really like this particular asset, and they kind of push. And we always hate to do it, but it's our job. We go to best and best and best and final. And that's what it seems like it's going to these days, right? And you go back to the buyer and say, hey, listen, just got off the phone with the seller. What can you do to differentiate yourself? Whether it's hard money, increase in price, or both, usually both. I mean, that's what it's coming down to. So there's a lot of capital in the market for these deals. And, as long as rent growth keeps going up, the buyers they know to a certain degree they're going to make good returns, and they're getting competitive for the assets.
Yeah, and to add to that, in terms of the number of people that we're seeing on these deals, I mean, I would say that even more so right now than last year, because I think what you have is a lot of guys in the space that we work in. You have a lot of guys who are coming into that space, graduating from smaller deals, and you also have competition above that space that's so intense that the buyers are coming down into that space. And so, by and large, we're seeing greater activity on every deal that we have to market right now than we maybe were 12 months ago.
And to answer, or to go back to one of your questions earlier about the difference in the last run and this one, I think the capital is a lot more sophisticated this go around. Whereas, it used to be a one-off guy buying a deal, where he sold a quadplex in California and buying a deal here. The underwriting and the level of sophistication from even your kind of one-off or one-at-your deal private shops is on par with most of the professional investors, and the way they assess the asset, align the debt, and execute the renovation. So I think it's really tightened up the offer groups. I think we had our last deal 12 groups within 1% of each other on an underwrite.
Wow.
I mean, it's pretty tight.
Yeah, they're becoming more financially sophisticated.
Correct.
So the grouping is closer together.
Correct.
And so, what are buyers looking for these days? I mean, are they looking for value-added properties? Are they looking for stabilized properties?
Underpriced assets.
They're looking for inventory.
Sure.
Yeah. I would say that there's demand for both value add as well as stabilized assets. I mean, obviously there are a million different definitions of value add, but I would say that generally in all cases, even on a, what you might consider a traditional stabilized deal, most of the guys are looking for some way that they can add value in it. There isn't too much distress in our market right now. So the heavy value add deal is few and far between these days. But, I would say by and large, the demand is heavier for a first generation renovation value add type deal than it is for a second or third generation value add renovation. So that's a lot of Asians in there. But, I would say that value add is still the key buzzword, in our marketplace today.
And why are people selling these days? I mean, you guys are out fishing, throwing your line out, trying to catch as many sellers as possible. And when you're trying to find somebody selling a property, why are they selling it?
For most, I think, of the clients that we've dealt with lately, most of them are executing a business plan, and they went in with a particular business plan to, hold the asset for a certain period of time, and or hit a specific number on their rents or NOI, and they've executed that business plan, and it's time to either move that money into a new asset or to take that money off the table.
Yeah, and to add to that, sometimes if they're sponsored capital, the equity is looking at an IRR, and if they're hitting their internal rate of return in year 2, even though they had scheduled a 3-year hold, they're pulling the trigger and moving the asset, and then redeploying the equity into something newer and bigger.
So the sponsors going to be compensated on a higher IRR, so the shorter duration they hold it, the higher the sponsor return is. That's been a common story.
Sure.
Yeah. Or we're dealing with sometimes fund buyers. I mean, there's a timestamp on those. So when the funds are, when it's time to sell them and close them out, and they're selling nationally, we try to chase that as much as we can.
So buyer pool today, from my perspective, I'm not only a lender but an active owner operator buyer of properties here in DFW. It seems kind of like you maybe have 2, maybe 3 different pools of buyers. You kind of have your institutional pool, which is off on their own. Then you have like your local guys like myself, and you have the out of towners. Maybe talk a little bit about the differences from your perspective in dealing with like an institutional buyer, a local group, and say like a group from the typical California buyer that comes to Texas. How do they interact differently with you guys? How they buy deals, and what's kind of some of the nuances?
Sure. So from our perspective, the buyer pool we primarily deal with is, private and sponsored capital.
Like your syndicator, like a one-off
Yeah.
guy out raising money. Right?
Sure. Your syndicator or your sponsor that's raising some type of programmatic equity from another entity as opposed to raising it from friends and family. And so, typically what we're seeing is that they are, in comparison to the institutional capital world, the private and sponsored capital guys are far more entrepreneurial, able to make deals work that maybe necessarily don't fit entirely inside the box. Whereas the institutional capital, it has to fit exactly inside the box. And I think that sponsored capital guys, generally speaking, are able to capture more value because of that. And they're also willing to take a little bit more risk as opposed to the institutions, and therefore they get rewarded for it in a market like this.
How does a local sponsor versus an out-of-state sponsor that does a private capital? What's the difference? Why would you choose a out-of-state guy over a local guy? Besides the obvious price and hard money, is that basically what the out-of-towners do to win these deals?
So I think for first-time buyers, when people call us and ask us, hey, I want to buy a deal, what do I need to do? I think for your first one, you're going to have to pay a premium because you're competing against people that have executed on multiple transactions with every brokerage house in town. They know each other. They see them around town all the time. So you're going to really have to distinguish yourself as the go-to guy to win the deal. So I'm candid. I just tell them, hey, you're going to have to pay up, put hard money up, and then actually perform and execute, especially on your first deal. Once you get in, you'll be found out quickly by other brokers.
Sure.
And then they're going to start pursuing you. So
Sure.
It makes it a little bit easier on them. For that first one, you need to step up.
Mike, what do you think about that, of what Michael's saying there?
Yeah, it's a completely unfair business. So who you know, what you know, and even getting access to deals off market or early, or getting the last phone call on a deal, just making sure that the guy with the track record has an edge, and it's a completely unfair business. So to get your first deal, you have to, like Mike and Will were saying, you got to differentiate yourself, and more hard money, going quicker, paying more. Those are some of the things that you have to do to get that deal done.
Yeah, absolutely.
Cash or assumption these days? I mean, a lot of people, when they buy a property, they have the money, but a lot of the sellers on these deals are forcing their hand to assume the loan. What are you seeing right now? Are you seeing a lot of assumptions out there? Seeing a lot of cash buyers out there?
Sure.
50-50, 60-40. I mean, what's that number about?
Yeah, I mean, by and large, cash buyers, we are seeing more assumptions being offered to the market. And, it's an interesting question, right now at this point in the market, because you'll obviously get a better rate today on an all cash deal than you would on assuming a deal that has, some, call it 7 years left on it. But you might be able to get a better basis assuming a loan on a deal in today's market. So it's something that I think we'll see more of going forward. But right now, by and large, I would say probably 80% of the transactions or more are all cash.
All right, Becker, in English, what the heck does that mean?
Meaning when you're going out and the property's offered what's called free and clear, you can go put your new loan on it yourself, and the rates today would be, say, 4% or lower potentially, where 12 or 24 or 36 months ago, the rates were about 5%. And then the new loans, what's really juicing the prices in these deals, in my observation, is not only do you get a little lower rate, you can go up to full 80% loan to value, where on these loan assumptions, you're 70 or 75, as well as you can get, 2, 3, 5 years interest only on these deals, where if you're assuming a loan, you're coming in amortizing out of the gate. So, and on top of that, on a lot of the new loans, will let you stretch a whole lot more CapEx into the deals and on assumptions. You can put some CapEx in and get a supplemental loan, but it's not quite as common as on the new deals. So it's really, I think, what's really fueling the pricing. One of the main components fueling pricing.
Yeah, we've seen several instances where our seller actually has a considerable prepayment penalty, but when we price the deal free and clear for the next buyer, it actually makes sense for them to pay that penalty and offer it to the market free and clear, because their net difference is so much better for them.
And when you guys are offering deals with loan assumptions, how many times do you get hard money out of the gate?
Very little.
And when you price it with free and clear every time, pretty much.
The loan assumption is just a difficult process. It takes a long time, and there's a lot of hurdles to get past that are outside of both buyer, seller, and broker control. At that point, you're at the discretion or mercy of the seller or the servicer, and it's just that's not a fun process most of the time.
So obviously, well, you were talking about the renovation, first gen, second gen, third gen, amenities, value add strategies. What are some of the things that when you guys are out selling buildings that have paid off for the ownership groups? What are the top handful of things? I mean, obviously everyone does interior unit upgrades, but what are a couple of top things that if I'm an owner, I should be doing to my properties?
We've seen this evolve quite a bit over the last, 5 or 6 years. And I think, one of the more popular things in the market right now is the addition of common area amenities that are more comparable to properties that may be a class or two above, your average B or C property. And so those are very popular. And I think that, there are countless examples in the market today, people having very good success in bringing traffic through the door and signing leases at higher rates by doing those things. And what I mean by that is, really upgrading the quality of the pools, the other common area amenities, dog parks,
Outdoor kitchens,
those things.
Clubhouse renovations are really big. So open areas, lots of windows. I mean, that's your point of sale. So most of the professional investors we're seeing right now do extensive work on the clubhouse. And that's where you actually bring the tenant in and make your sale. Right? So you want it to be inviting. Landscape and signage are large as well.
One of the things that we're about to do on two of my properties are package rooms. Have you seen anyone in the B and C space do package rooms?
We've just recently started hearing about this.
You're on the front edge of this.
Look at that.
What are package rooms, Mike?
So one of the operational issues for apartment complex nowadays is everyone orders stuff online from Amazon or wherever. And if you live in a home, UPS will drop it off at your front door. But apartment complexes, they don't do that. So they drop them off at the office. Well, if you want to go pick up your package, you have to be between 9 and 5 when the office is open. Mm-hmm. So people will put these electronic lockers in where the UPS or the mailman will drop it in the locker and it'll send a text code to the resident and they come in 24 hours to that code and retrieve their package. And so that's a great amenity for the tenant, and then it takes time off the staff from collecting all this and then we're returning them to the tenants when it comes. So especially on the younger demographic, like more student housing or just kind of just uptown hip living, that's more and more of an operational issue for these properties.
I can speak personally to this. Every day I come home, my wife has a new box from Amazon Prime on her front porch. So it's actually amazing. This wasn't thought of earlier. Yeah. And I think in 5 years from now, it's pretty much going to be the standard for apartments.
The problem is they're not cheap. So we're like pricing out just the equipment on, say, a 300 unit deal is about 35, 40 grand. Plus you got to install it and retrofit your building to make sure you have secure access to it. So it's a costly amenity, but it seems to be the wave of the future for sure.
Absolutely.
Now, you guys walk a lot of properties. I mean, what else are you seeing out there for amenities? I mean, dog parks, of course, and be climbing rocks. But, we're really talking about B and C properties, and this type of stuff. These old, tennis courts, what's going on with those things?
Yeah. So, a couple things. I've seen a lot of people convert them to kind of miniaturized soccer fields. And you put in smaller goals and you can put 2 soccer courts on an old tennis court. We've actually seen one guy go in and he put a playground and built it into the old tennis court and then installed a fireplace, built it into the slab, and then also put an outdoor, basically like a picnic area, covered pergola with picnic tables, ran some TVs out there, and just converted the open kind of slab into an outdoor kind of grilling and playground space with some soccer courts, take the kids out. So they actually did a really good job, and I was impressed.
Yeah, we've seen people do things like bocce ball areas. People are getting really creative with this stuff nowadays. And on almost every 1980s property that we see with the tennis court, it is just like a giant waste of space sitting there for the most part. And so, I think that improving that in a lot of these deals is certainly beneficial for the tenants. They have a place where they can kind of hang out outside and kind of get a more community feel, get to know their neighbors, et cetera. So I think it's a very good thing. And, we're seeing more and more of it every day.
So this isn't a community amenity, but this is one of my favorite exterior improvements. Mm-hmm. There's a couple local groups that have been doing this. It's a horizontal cedar plank kind of siding, I guess, on the balconies.
Yep.
And we've seen a couple of properties that were in pretty bad shape when they bought them. And for whatever reason, I feel like it just completely changes the face of the asset. And I'm a fan now.
Oh, I absolutely love it.
I'm a huge fan.
It looks fantastic. I know, Mike, you have that on a couple of your buildings too.
Several,
I mean, it really updates the look to the property.
Agreed.
And makes it look a lot more modern.
Yeah, that, and we've done several like extended backyards. That's been a big hit, and you can charge $75 or $100 a month for
Throw a grill
a
out
little
there,
private
so
backyard. So I'm an owner of a property. I want to sell it with Mike and Will from Berkadia here in Dallas. What are some of the things I can do to help myself or help me sell my property? What are some of the things that the ownership groups do poorly, and what are some of the things that do well when they're prepping the property for sale or during the disposition process?
I'll start off and you can finish up. So I think it's get ahead of it early. So communication, kind of, we call it market positioning. So it's a process. I think a lot of sellers who don't trade a lot, I mean, you can just pull the trigger and go to market within 30 days, but I think that it's best to prepare for it and kind of plan for it and kind of work with your broker to figure out, what's our strategy, what can I do moving forward to get this thing ready to sell, and when's the best time to sell. And with that comes a whole list of items to kind of get ready for it.
Yeah, and I would say there's a couple of things. For us, the most important thing is being able to work with the on-site staff of the properties hand in hand. They're an extremely important part of the process. They probably know the most about the property on the ground, and oftentimes they're not included in the sales process except for to do property tours. And so obviously they're not going to know everything about the process, but having them buy into the sales process, I think, is very important for us. And being open and transparent with them about what happens during the sales process is very important, and it makes it helps to build synergy in the sales process and certainly the transition. And the other thing is on these renovation projects, keeping detailed records of pre-renovation rent, cost of interior renovation, and then post-renovation lease rent is extremely important for us to be able to sell the story to the marketplace once we go to market.
Speaking of that, what in your mind, and I always ask everyone this question that either sells apartments or owns apartments, what's the right number of units to upgrade? So you want to sell it for profit, you got to leave some meat on the bone, because we keep talking about stories, buying a story. Everyone buys a story, so everyone needs to have some level of upside.
Sure.
That's a magic question here, but
it is. And I would say that for us, we have seen that the less renovation, the better, but doing enough to be able to prove the upside in the deal is very important. So generally speaking, less than 10% renovation doesn't really prove the story, and more than 30% is kind of frowned upon by the guy coming in. So somewhere between 10 and 30%.
I think 20 to 25% is kind of the magic number. And when we've seen be really successful, we just closed a deal and it got pretty aggressive. But they took care of a lot of the major renovation projects or deferred maintenance, right? So they shored up the property and then did a great clubhouse renovation, landscape, and some exterior, like hardy, throughout the entire property. Did a small amount of the units and made it to where the incoming buyer could literally just take this story to their board or their investor committee and show them, hey, look, if we just finish this plan and follow the plan they've already put into place, this is what we're going to make 18, 24, 36 months down the road. And it just made it easy for the next buyer to come in and really prove up the story.
Paid by number apartment investing, is that what we're doing nowadays, right?
I mean,
indeed. And I also, to add to that, I think that the tiered renovation program is important. So a one size fits all renovation really kind of, I think, limits your story. And I think that when you do a different variations of levels of the upgrade, you leave a little bit more meat on the bone and you have a better story to tell.
And adding to that, so what's amazing, I think, for me is we talk to obviously hundreds of active buyers every month, right? On every deal, we field a large number of offers, and every single person we talk to has a different plan, which I always find very interesting because everyone sees the asset differently, a little bit differently. And it's always interesting for me to sit back and kind of hear what their plans are, what they're seeing when they're walking the property, or what they want to do with the amenities. So we try not to limit ourselves as well as far as, hey, here's our plan. You kind of show them, here are the tiers and the upgrades. Here's what's the pros and cons of the asset, and let them kind of run with it. And it's always amazing to hear the feedback from them.
Yeah.
So we talked a little bit about help me help you for the seller. Now help me help you as the buyer. What do you want to see from the buyer side? They call you up, they want to get a relationship with you. What do you want to see from them before you even start talking, or do you just immediately go into it without reviewing what they want to do? I mean, tell me how you work with buyers.
Sure. So I think that be honest here, immediately as soon as we start talking to a buyer, we start assessing credibility. It's what we get paid to do by sellers, is to assess the credibility of the buyers. And so, one of the very first things we look for is, does the buyer have credible financing? And if we check that box, then we, look a little deeper and say, do they have credible equity? Essentially, what I'm saying is we look at whether their capital stack is in order. And if that's the case, and we find that out that there is credibility there, then essentially we start putting deals in front of them. And so that's really kind of how it goes from the onset. Then as you begin to look at deals together and you begin to get feedback from them, you kind of begin to figure out exactly what hot buttons are, exactly what they're looking for, and you can kind of I think at that point in time begin to find you'll eventually find a deal that will match.
Yeah,
So,
when you get a feel for how they underwrite and if they're being realistic.
Yeah.
And if a guy calls you up and says, hey, I want to buy a B-class asset for an A-cap, he hasn't done his homework or looked at any deals in Dallas in the last 3 or 4 years. When's the last time you've seen an A-cap, right?
Years, yeah, 3 years.
So we get a lot of that, and it's just kind of we'll call them and put the deal in front of them, but who the active and qualified and real buyers are pretty quickly.
The qualified buyers that have talked with old capital.
Exactly. Going back to what Will said, we ask them, hey, who are you going to use for debt?
Right.
What's your capital stack look like? And if they kind of stare at you like a deer in headlights, they haven't really thought about it, or they really don't know what they're doing.
Yeah.
You don't really want to share financials with your client's private information.
Yeah.
So we're not just going to blast that out to anybody. So you want to know that the person's credible.
Yeah, and regarding old capital, at this point in time, we've been in this business long enough where we know just about everybody who's active in it. And so, one of the things that we look for is, are they working with someone that's a credible organization like Old Capital? And that tells us a lot right then and there. So
maybe give us a couple examples here. It's been a pretty busy year, I think, for you guys. Maybe the last handful of deals you guys have done. Maybe something that you got coming up on the market, something like that. Let's kind of give a little flavor of what kind of volume or what kind of deals you guys are out there doing.
So for total volume this year, we'll probably end up close to around $400 million in total transaction volume.
At Berkadia, Dallas?
At Berkadia, Dallas. So we're on a 5-man team in our shop. There's 3 other guys that are not here today. And most of that's middle market. So we do anywhere from 70s to 90s is primarily what we're chasing.
Vintage,
we've done some
year
newer
construction.
Yeah, year construction, excuse me. So we'll chase some newer stuff. We closed some nice A deals this year, but that's not what we really do. Our bread and butter is BNC multifamily in Dallas-Fort Worth.
And your numbers probably for sales prices between, say, 3 to 30 million?
Yeah. That's a pretty good range. I think our average deal size is right around 10 to 12, and this year we did our average $4.5 million earlier. And
our average deal size this year is going to be, north of 20 probably, but we've done a $4 million deal in that time and a couple $10 million deals, and then quite a few deals that were in the 20 to 25 and then 30, and then one whopper that was north of 60. So that, those are always great. But our bread and butter, like Mike said, is probably in the $15 to $20 million range. Most recently, we'll be closing in next week on the 20th on a 320 unit deal in Southwest Fort Worth, which will price out in the mid, just north of 26 million. And that's a value add deal. We did a deal called Ladera Ranch earlier this year, which was 280 units in Irving, which was, in the low 20s. And then we should be closing soon on a 2008 vintage deal in Louisville, which will be just north of 30 million. So,
and we just listed 316 units in Las Colinas, quote unquote, or North Irving.
All right, I get it. You guys are busy.
Yeah. So just a couple of examples of recent deals, there.
So back to it though. BNC is that's where we understand. That's what we chase.
And the deals that you guys close, the people who won the deal, who actually were offered the contract itself, was it sales price? Was it hard money up front? Was it a buyer that you already vetted out before? Give me, without naming names, but
Sure.
Give me kind of an idea of why they got that deal.
So the last deal we put under contract, the buyer, who I believe you know pretty well, was actually awarded the deal. They were not actually the highest price offer. They had done business and transacted previously with our client. So they were comfortable with each other. They had a contract that they had already used and they had performed in the past. So, the seller just said, hey, we know this person. We're comfortable with them. Let's move with them.
It was a bird in the hand versus the, proverbial bird in the bush, or two in the bush, I guess. And so, that really solidified, that deal in the favor of that buyer. And I would say that on a couple more deals that we've done recently, it has not been the highest price buyer at the end of the day that's been awarded the deal. It's been the buyer that had the greatest certainty of close. Yeah. And there wasn't an outrageous difference between the pricing, but they were close enough to where the clients were comfortable with someone who wasn't in the top pricing slot.
Did any of those people not have experience prior to taking that deal down? Were they all veteran?
They were all veteran buyers. I think on our last 3 or 4 deals, it was just kind of like Will said, certainty of close, and I think also just a comfort with the process and knowing who you're dealing with. So it, I guess, prevents brain damage in the contract negotiation and escrow phase. So if it's a smooth escrow, I think that's a factor to a lot of sellers is, how much headache do they want to take on?
So kind of wrapping up some of the things that I heard you guys say when, if you're a first time buyer, which a lot of our listenership is either first time or maybe second time ownership in a deal, the things that matter when you're trying to win a deal or just getting your capital stack lined up. So who's your equity? Who's your debt? Hopefully that answers Old Capital, but who's your debt?
Yeah.
Are you dealing with experienced professionals? So your service providers as an ownership group, your management company, your lender, your insurance company, people that the active brokers in the marketplace know of and respect.
Yep.
So it gives transfer of credibility. Do you guys have a track record? If you don't, you overcome it by being aggressive with your terms and your pricing and getting an experienced team around you, making sure that when the broker asks you for your underwriting, you have good answers and you know how to underwrite a deal and you're realistic within your pricing expectations. Any other things that I didn't kind of list off here that would be key to win a deal?
Those pretty much cover it. I would say that one of the things that we also look at is, other references in general, even with first-time buyers who maybe have a reference from somebody in the industry can be important as well. So that's the only thing that I would add there.
I would just say be proactive and be patient as well. And there's a lot of smart people with a lot of money chasing the same product. And it's a numbers game, right? So you're going to have to look at a lot of deals to get one. Look, we're covering a lot of ground and talking to a lot of people. So I feel that the most successful buyers are very proactive and also chasing the brokers and just letting them know, hey, I'm here, I'm active, I want to buy deals. And you kind of stand out and your name sticks out after time. And it's, finally you kind of get mind share and, you swing enough times, you're going to hit one. So.
That's right. So what's the best way if someone from our listeners podcast wants to get a hold of you guys? What would be the best way to reach out to you guys?
Yeah. So this is Michael Ware, and you can reach me at michael.ware@berkadia.com.
All right, let's spell that because there's different ways of spelling Ware.
Sure. So michael.ware@Berkadia. That's BERKADIA.com.
Well,
and will.jarnagin@berkadia.com, will.jarnagin@berkadia.com.
But they can also go on the Berkadia.com website, look under Dallas, and you can find the guy's name on the list there too. Anything more you guys want to add to people that are thinking about getting into the business? Any words of wisdom that you could share with them from, you guys have done this for 10, 12, 15 years or so. Any words of wisdom to help people out?
I guess the thing that I would, say, most is find examples of other people who are successful in the business and follow what they do. There are a lot of people who enter this business and think that they can reinvent the wheel, et cetera. But emulating those that are successful at doing it, I think gets people a long way. So that would be
I'd echo that. I think all of us have had a mentor at some point. In this business, and I think it's critical when you're getting your start to learn from someone that's been there and done it and kind of seen all the traps, or will tell you, hey, don't go to this area or that area. There's a lot of pitfalls, right? And there's a lot of upside, but it always helps to have someone you can trust and go to for good advice.
That's great. Michael?
Yeah, just this business is very, very simple. It's just not always easy.
I agree with that.
That is true. So I think definitely getting yourself experience with the right team, experience principles with proven track records along the way, and all your service providers, and calling on the right brokers, because in this community, it's a pretty small community. There's 4 or 5 shops that do 80% of the volume here, or 90% of the volume probably in the space, and so you got to make sure you get networked and you're saying what you're going to do and you do what you say, and that'll go a long way.
One of the best ways to get networked is getting to know Michael Ware and Will Jarnagin with Berkadia. Guys, thanks for coming in. We appreciate your time. Michael Becker, thanks for your time too.
Yeah, we should probably have everyone, if they want to learn a little bit more about the business, maybe email info@oldcapitallending.com, and we have about a 12-page white paper kind of detailing the ins and outs of multifamily finance 101. That'd be a good way to do it, and we can also get you on our weekly email blast, which kind of has tombstones of deals that we've done. So I think go to info@oldcapitallending.com, or go to either our other website, which is oldcapitalpodcast.com, and you can look up the shows that way as well.
That sounds great. Guys, thanks for stopping in the podcast. We appreciate your help.
Thank you, guys.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.